Hey, and welcome to Lecture 16, the final lecture in our quantitative section of the course. And we're going to finish it off with volatility. So what exactly is volatility? There's a lot of confusion surrounding what exactly this means. Let's clear it all up. So volatility is basically the degree of variation of a price series over time as measured by the standard deviation of returns. And in more layman's terms, we are going to talk about high volatility as price moving around a lot, and low volatility meaning price is quiet and not moving around a lot. So there's two primary ways that traders like to measure volatility. The first one's the more quantity academic way, which is just the straight up standard deviation of returns. And the second one is average true range, which actually looks at the dollar range on the day of the instrument and then averages out over a period of time. So this is historical volatility. It is the standard deviation of returns. You can see here's the equation for it. And a quick caveat, vol is usually quoted on an annualized basis. So when you see volatility, you usually have to divide it by 252 to get a daily quote. So for example, the VIX, let's say the VIX is quoting 15%. To get the expected daily move of the S&P 500, we'd have to divide that by the square root of 252 because there's 252 trading days in the year. And the square root of 252 is about 15.87. So this equals roughly 0.945%. And so that would be the daily expected move of the S&P with the VIX at 15%. So that's just a little something to keep in mind when you're reading historical volatility. Average true range is more intuitive, trader-friendly indicator. And all they do is they take the largest of these three things right here. So the period's high minus the most recent period's low, or the absolute value of the most recent period's high minus the previous close, or the absolute value of the most recent period's low minus the previous close. These are for gap situations. And then they take this true range, the largest of these three is called the true range, and then they average it out over the last X days. And what happens is we get an average reading for how many dollars or how many points the market is moving per day. So in this example, this is Apple. You can see I have ATR and HV listed below. And ATR, it's basically right around 2. So it's saying that the average true range of the last 20 days for Apple stock is about $2. And so it's just much more intuitive and easier way to find out, hey, well, on average, how much is this thing moving in a day? Whereas HV, it is, remember, quoted on an annualized percentage term. So this says 20%. So to get the expected move for the day on Apple, we'd have to do 20% divided by the square root of 52. So the one downside, though, to ATR is for stocks that make huge long-term percent changes. So something that goes from, say, 100 to 10, it could be very misleading because ATR can be downtrending even though the actual percentage moves are increasing. And let me just show you guys in a quick example of this. So this is Cliff's Natural Resources. And so we're on the weekly time frame. See how this stock went from about $40 all the way down to $6. And even though when CLF is low like this, the actual percentage moves are larger, as you can see by a rising historical volatility, we get a downtrending ATR just because, remember, ATR is points or dollar range on the day. And because CLF is such a low price stock now, it could have a $1 up move or a $2 up move, and that's a huge move on a percentage basis for the stock. But back then, a $1 or $2 move was not. So that's the one downside of the ATR, something you got to be careful about on very long-term time frames. So another thing worth noting is that volatility is not trending. So a lot of people get this confused. You can have low volatility trends, and you can also have very high volatility consolidations. So high volatility markets that don't go anywhere can just look like this, right? Back and forth. And we can easily have low volatility markets that just slowly drift in one direction for months and months on end. So we don't need to have high volatility in order to have a trend. That's something a lot of people tend to confuse. Now I'm going to go through the different states of the market just so you guys can get a better understanding of it. So for instance, here's what sideways quiet would look like, just very smaller range, but going sideways. Sideways volatile is much more intense range, but still going sideways. And bull quiet, you see we have a nice smooth uptrend with very small pullbacks and just tiny little congestion zones that barely pull back the prior move. And bull volatile, on the other hand, has these huge pullbacks. So we're still uptrending, but the pullbacks are enormous. And then we got bear quiet, which is similar to bull quiet, right, where we just have a downtrend with small little moves, counter moves. And then bear volatile, which is we have the huge retraces. So let's point out a few examples. I got the E-mini S&P futures up here. And let's just look at this consolidation. So this area right here, this particular consolidation zone, has a pretty wide range. And I would classify that as a highly volatile consolidation. Whereas this consolidation up here is a quiet consolidation. You can see how the bars are much smaller. And we're not really going much anywhere, but the range is very compressed. Whereas here, we're not really going much anywhere, but the range is expanded. So that's how volatility differs from actual direction. We don't necessarily have to have high volatility trending and low volatility consolidation. And here's another chart so I can show you guys the difference between a bull volatile and a bull quiet. And you can see if we look from the macro picture here, this trend on the macro level is bull volatile. So we have these very, very deep retraces. But let's just zoom in and for instance, let's just look at this part of the trend right here before that deep pullback. And that's more representative of a bull quiet. So see how we pop up and then we have these very shallow consolidations, pop up, shallow consolidation, pop up, pretty shallow. And so that's more what a bull quiet trend looks like, whereas the macro trend here would be more bull volatile with steeper pullbacks. And here's a good example in the yen futures of a bear quiet trend. So look at these nice long down moves with not sharp retraces, very contained retraces all the way down. So this is a great example of a bear quiet trend. And then finally, we got a bear volatile trend. So this is the S&P 500 ETF back after the dot-com bust. And you can see, this is first off, we had a highly volatile sideways range and then a pretty volatile down move. These retraces are very sharp, much different than this yen chart where, the retraces are not that sharp. We have a very clean down move. This is very noisy coming back up with hardcore counter trend rallies on the way down. So this would be a good example of bear volatile. So why do we want to understand vol? Why do we want to pay attention to it? As a macro trader or even a fundamental trader, a lot of guys, they just completely throw this out and say, hey, I don't even really need to care. This is just for the quants. But in reality, price's volatility is actually more predictable than its direction in many ways. So extremes in both high and low volatility are unsustainable in markets. Volatility has a mean reverting nature to it. So ultra high volatility turning lower signals a move is about to end, and ultra low volatility turning higher signals a move is about to begin. And Paul Tudor Jones used to talk about this all the time. Every time I've seen volatility like that, I don't care what the market was, whether it was soybeans in 76 or 83, or whether it was silver at the top in 1980, or whatever it was in some of the biotech stocks at the top earlier in the 90s. When you get that kind of volatility, you know that generally that's associated with the top. So in this silver futures graph, we have the HV, the historical volatility graph below. And this huge move to the upside was accompanied by a huge blow-off top in the volatility, and that signals that the move is about to end and we're going to have to return to a more lower volatility state. Same thing with the market, the S&P 500 after the '08 sell-off. You can see at the very lowest point of the down move, we had extreme volatility readings that just can't last forever, and we know the volatility is going to mean revert. We're going to go into a more quiet part of the market, and sure enough, volatility did mean revert, and we started a new trend the other way. So from a tactical perspective, from a trade entry perspective, volatility can help us as well, and especially if we're trading a breakout system, and we at macro ops like to trade pattern-based breakouts, and these things have a dramatically increased odds of success during a rising volatility regime. So if you overlay this concept of vol compression expansion onto a breakout system, you can significantly improve its results. And Paul Tudor Jones had a great quote about this. When you get a range expansion, the market is sending you a very loud, clear signal that the market is getting ready to move in the direction of that expansion. So if you remember back to that Grimes study we looked at of the 100-day channel breakouts with momentum, and let's focus on this equities column right here. When we bought 100-day highs in equities, the results didn't turn out well, right? We had actually negative returns following it. And when we sold breakdowns in equities, we had positive returns following. So it didn't turn out well. But now look what happens when we qualify with the volatility overlay. So if we look for a point where volatility is relatively dampened and we have this sort of price action before the breakout, then the results completely change. So here's a picture or a chart of what I was drawing on that slide earlier. We have a more quiet area from an ATR perspective, a volatility perspective, and then a breakout on rising volatility. And here are the stats now for a breakout qualified with this volatility compression expansion concept. And we can see it's completely different. So for equities, remember we were just buying those 100-day channel highs, we would get negative returns, and now we're seeing positive returns coming out of the buy signal. And on the sell side, we are seeing continuation on equities as well to the downside if we use this volatility compression expansion concept. So it's a huge difference from the trash performance of just buying 100-day channel highs in equities and selling 100-day channel lows in equities. We instead qualify breakouts with volatility compression and the stats drastically improve. So in summary, the big takeaways from this lecture are extremes in high and low volatility are unsustainable, and they indicate a market with potential to change character or trend. And this is the biggest thing about this lecture. Following a low volatility sideways phase, the highest probability scenario is a transition into a high volatility trending phase. And this statement right here is one of the primary reasons that chart pattern trading works. It's because we have this constant ebb and flow of consolidation and trend, expansion, contraction nature of price action. And paying attention to volatility can help us find the absolute best trading entry points when we're looking at price charts.